express my gratitude to the co-organizers of the event, because without friends, you're just alone. So the Ministry of Finance, also the Bank of Lithuania and the Lithuanian Banking Association, thank you very much. Also, thank you very much for all the speakers who agreed to participate here today and to share your views with us. I think that conferences like this is a perfect platform to gather all of us together, to share our views, and maybe to find new solutions if we're stuck, like with the CMU in Europe. Because I remember my first days in the Ministry of Finance, and I would say that the level of achievement in the CMU agenda was more or less the same as we're here today. But at the same time, I think that it's a perfect time to discuss that today, because there's a new political cycle coming not only in Lithuania, but at the same time in Europe. Now we have a new European Parliament. We will have new European Commission very soon. And from my perspective, I feel that the time has come, and everybody understands that CMU, Capital Markets Union in Europe, is something that should be done during this political cycle. And the sense of urgency is there. I have felt it in the discussions with the other ministers of finance, in the Eurogroup meetings, in ECOFIN meetings, but this time I think that the sense of urgency is not only between the ministers of finance, but also in a general political understanding. And I would say that the reports of Mr. Draghi and Mr. Letta let us know that we have to do something, and Capital Markets Union is one of the key achievements that should be achieved during this political cycle. So I think it's a good time to gather us here today to discuss about the future of finance in Europe, but at the same time, there is also always room for improvement for ourselves. We can do something even if Europe is not moving together with us. So some regional cooperation between Baltic countries has been present in recent years. So we have what to share, the examples of good practices. And I would say that we can be shown as an example to those who are thinking about Capital Markets Union, how to move, how fast you can move, and what are discussions between the member states. So today's conference discussions will concentrate on the most pressing issues for the EU and Baltic capital markets, as well as the core role of the European Capital Markets Union and its impact on regional financial frameworks. Also, discussions will cover trends in Baltic debt and IPO markets, the challenges for SMEs accessing finance, and strategies to attract investors. Also, we will explore the measures how to unlock retail investments and how to shift savings into productive investments. And I hope that these discussions will follow with some solutions as well. So thank you very much, and have a nice day today, and have a nice discussions. Thank you.
Thank you very much. We are extremely delighted to have the Prime Minister of Lithuania with us. Ms. Ingrida Šimonytė comes on stage, and we give her a big hand. Thank you.
Thank you, Gintare, for your welcoming remarks. When you were mentioning that not much has moved since you started in the office in 2020, I was thinking, has much moved since I left the Ministry of Finance in 2012 or Central Bank in 2016? And I think I'm coming to the same unfortunate conclusion so far. But first and foremost, I would like to welcome everybody to this International Financial Markets Conference. And I think the fact that this is already the 10th annual conference is a testament that capital market development is an important long-term priority for Lithuanian authorities and market participants. I can say that during our term, the government was trying to make significant contribution to fostering and development of national and regional capital markets, trying to facilitate business access to finance and increasing the supply of financial instruments on the market. Our work in this area has been guided by the Capital Markets Development Guidelines and overseen by the Capital Markets Council, which encompasses all relevant public institutions as well as a broad spectrum of private sector stakeholders. In my view, the Council is a very good example of public-private sector cooperation, ensuring that capital market development aligns with the needs of the market participants. And allow me to briefly mention what I consider to be an important steps in the recent years. First of all, the establishment of the investment account for people, for our citizens, for our taxpayers, which will simplify the taxation procedures for income from financial investments, thus creating conditions for Lithuanian residents to invest more conveniently in various financial products. In my view, this instrument can play a pivotal role in encouraging retail participation. Second, the issuance of government saving notes and defense bonds, which brings at least two benefits. First, we have introduced a new saving instrument which broadens the options for people how to save their money. Second, for many individuals, government saving notes and defense bonds will be just the first engagement with financial markets, and these instruments might serve as a gateway to further participation. Third, and I think the most important, we've made substantial progress in building the Baltic capital market. Many important steps have been taken towards regulatory convergence and regional consolidation of the pan-Baltic capital market, making it possible to integrate all free market into a single index. This is a significant achievement, raising the profile of the region among international investors. On top, we're about to launch the Baltic Capital Market Development Accelerator Fund to enhance the listing activity at the Baltic Stock Exchange. Finally, I must highlight the focus on the green finance agenda and its crucial role in financing the green transition. Without a doubt, the investments needed to transform our economies is massive and requires special attention. To this end, we have adopted the Lithuanian Green Finance Action Plan, which aims to make Lithuania a regional leader in sustainable finance by creating a financial ecosystem that will encourage more private investment into sustainable sectors of the economy. An important element of this ecosystem is the Green Finance Institute, a public sector think tank operating as the main driver of the green finance agenda in Lithuania. Overall, a number of important developments have taken place in recent years to improve capital markets at both the national and regional levels. And I see this as a fundamental building block for the broader EU agenda while building the European Capital Markets Union. As Gintarė mentioned, CMU will be high on the next Commission's agenda. And there are several reasons for that. First, Europe is facing a competitiveness challenge, which is a major issue highlighted by the reports of Enrico Letta and Mario Draghi. The EU is lagging behind in global competition, and we must find new engines of growth to remain a leading economic power. The key takeaways is that competitiveness is not just something nice to have, but is an absolute necessity. Second, Russia's war in Ukraine has significantly increased geographical and geopolitical fragmentation globally and has greatly affected the security situation in the region. This new reality demands that we strengthen the EU's strategic autonomy across all sectors of the economy, including finance. In this context, capital markets are crucial to enabling the flow of finance into green and digital transitions, boosting innovation and productivity, and it plays an important role in financing investments to strengthen our defense industry, which needs to accelerate its capabilities. The stakes are high, and we must make further efforts both at EU and national levels to support capital markets development. In my view, there are several priority areas. First, our financial markets must evolve to offer better access to financing for businesses, particularly small and medium size, which form the backbone of any European economy. At the same time, we must ensure better financing opportunities for startups and young innovative companies that need investment to scale up their operations. When compared to the US, this remains a weak spot in the EU, as companies with high growth potential often choose US market to seek funding. Third, it is essential that we continue pursuing policies to break down barriers to investment and reduce fragmentation. We must work towards a single rule book to ensure that regulatory framework is both effective and efficient across all EU jurisdictions. We also need to pursue targeted convergence of national corporate insolvency frameworks, accounting practices, and better integrated market infrastructure. Indeed, the scope for action is very broad. There are many suggestions on the table, and I hope today's discussion at this conference will contribute to finding the best solutions to make both Lithuanian and European capital markets deeper and more efficient. Thank you.
Thank you very much. And obviously, the Prime Minister does have a very busy schedule, so we let her go and do her work, and we are very grateful that she was here with us. We will get into business as well, and we'll begin with a keynote speech. With us, we've got Chair of the Supervisory Board of the European Central Bank, Ms. Claudia Maria Buch, who will deliver a keynote presentation, and I want to welcome her on stage right this very moment. Thank you.
Thank you very much. Thank you very much for the very kind invitation from the organizers. Dear Minister, dear Governor or Governors, dear ladies and gentlemen, it's really a pleasure to be here. It seems that we're actually celebrating 3 anniversaries. So one is the one of this conference, and I'm actually among those who are here for the first time. So it's really a great pleasure. And we also celebrate the 10th anniversary of the single supervisory mechanism. So as you all know, with the banking union, Europe has really demonstrated its ability to respond to crises in a united way, moving to more harmonization, more integration, rather than retreating to national solutions and fragmentation. And we have a lot of achievements in terms of better resilience of the banking sector, reducing risks, applying common standards, and we work very closely here, of course, with the national authorities. And we can also now benchmark banks across each other, across Europe. But when you look at these achievements, they really pale in comparison to the progress in terms of transformation and integration here in the Baltic region. So this region has really gone through 30 years of institution building after the disintegration of the former Soviet Union. There was a massive economic transformation following the changes in relative prices, the disintegration of trade and the reorientation of trade flows, and accession to the EU and also the adoption of the euro, also roughly 10 years ago, are only the most visible signs of this transformation. And I think this is not to be forgotten what has been achieved here. GDP per capita has really caught up a lot compared to the European average. This region is actually leading the way in Europe in terms of digital transformation of societies and economies. And there's been a high degree of financial integration, high shares, market shares of foreign banks in this region. So these are really remarkable achievements also when we talk about the reform agenda that lies ahead. But this region, and I think many of you still recall this very vividly, has also to some extent experienced the downsides of financial integration. So prior to the global financial crisis, there was a real appreciation of the domestic currencies, some unsustainable credit expansion, and when capital flows suddenly stopped, there was a need for a massive adjustment of the real economy, with a very painful recessionary period also for the population, declines in real wages, increases in unemployment. So I think this a little bit longer history, longer than the 10 years, fortunately, needs to also be borne in mind when we want to look at what lessons can we actually draw from the experience in this region, maybe also for the future integration and process in Europe. And for me, the first lesson really is that we need resilient banking systems to support transformation. And resilience, of course, means sufficient capital levels of capital. It also means sufficient operational resilience. And it also means the massive improvement in the quality of financial services that we have seen here. The second is, and this is related to this aspect that I mentioned, there's also downsides to, or there can be downsides to integration. Of course, we want to minimize them because we do need strong supervision to ensure this resilience. And the banking union has really been a great step forward in this regard. And I think it has particularly also benefited this region here. But we need to, and this has been mentioned already, we need to go further, so we shouldn't stop here. The future of integration, of development of the financial sector is likely to be much more digital than it used to be. So in that sense, borders will matter less. There will be a more beneficial cross-border risk sharing, but there might also be risks that affect other regions. So I think we need to move ahead with European deposit insurance, which of course, deposit insurance is currently still organized at a national level. So that needs to match also the cross-border movement of risks. And of course, we need to move ahead also with regard to capital markets union, because we know that the often very risky and long-term investment needs of the European economy cannot just be met by bank capital alone. So these will be my main messages. Let me go into some more detail and go through the experience of this region and how it can really contribute, also learning lessons for Europe and taking beneficial insights. As I said, this region has really gone through a period of 30 years of a rather unprecedented period of economic transformation and financial integration. And I think, but there are many in this room who can certainly judge better than I can, but I think this is also due to a very strong consensus in the society that it was necessary to join the EU, to adopt the euro, which happened, of course, EU membership in 2004, and then stepwise the euro adoption in Estonia a little bit earlier, 2011, and then Latvia, Lithuania followed in 2014 and 15. And this was also the entry into the single supervisory mechanism, the banking union, in those years. So basically the countries here have been members of the single supervisory mechanism from the beginning. Banking sectors have developed very rapidly after, of course, turmoils in the 1990s, in the transition from the former Soviet system to a modern market-based system. So in the 90s, the financial sectors relative to GDP were, of course, relatively small. Today, banking sectors are around 130% total assets of banks, around 130% of GDP, which is much higher than in the 90s, but still below the euro area average. Many banks in this in the 1990s left the market, and foreign banks, in particular from the Nordic region, so there was a strong regional component, entered the markets here. And today, when we look around, foreign banks dominate with around 80 to 90% dominate the domestic markets. Initially, there was also a very strong integration of interbank markets, but that was also partly the problem during the global financial crisis. I will come to that in a second. But in a nutshell, the 90s, the early 2000s were really a success story of successful integration, higher GDP per capita, financial integration, a significant transformation of institutions, and at the same time, very solid monetary and fiscal policies with pegged exchange rates and low levels of public debt. But at the same time, and this is something that we haven't just experienced in this region, but that we very often experience globally, vulnerabilities have been building up beneath the surface, in the sense of overvaluation of real estate markets. Very often, the issue when it comes to crisis situations, exchange rate appreciation, a strong dependence on the financial health of the parents and the interbank markets, and perhaps even, I'm talking about the period before 2008, perhaps also a little bit of over-optimism with regard to future productivity growth and the benefits of EU membership. And then came the global financial crisis with a sudden stop of cross-border capital flows, not only in the Baltic region, but in many other countries in Europe. The one main difference here was that because of the quasi-fixed exchange rates and of course, the unwillingness to give up monetary credibility, it wasn't possible to devalue the national currencies, which would, of course, have allowed the corporate sector to adjust more easily to the external pressure. So what was the adjustment route that was taken was rather a heavy burden falling on real wages and labor markets. So unit labor costs were lowered through a combination of lower nominal wages, layoffs, and also increases in productivity. It depends a bit on which country you look at. Adjustment here in this region was faster, though, and there's empirical evidence showing that was faster than in countries that at the time were already members of the euro area and had access, of course, to the lending facilities of the European Central Bank. So the internal adjustment mechanisms with all the negative implications, of course, for societies worked quite fast. Still, there was a deep recession in 2008 and 2009, GDP declining in the double digits, and this was, of course, also felt on banks' balance sheets. So non-performing loans increased to 20%, around 20% in Latvia and Lithuania, less so 5% roughly in Estonia. So this was the impact of the banks, a withdrawal of interbank funding, a decline in cross-border capital flows, but at the same time, the foreign banks that were in the markets already stayed. So they stayed, and they also helped to recapitalize the banking systems to deal with the non-performing loans. So when you then fast forward a little bit to the banking union and where we stand now, this region is actually a very highly capitalized banking sector. But before going into these comparisons, let me say again why it was so important that we collectively learned the lesson from the financial crisis and why banking union was so instrumental in this. Because basically the global financial crisis told us, and the European sovereign debt crisis, of course, told us that national authorities cannot deal alone with the risks coming from financial integration. So we need benchmarking, we need the same supervisory standards. We also need mechanisms to deal with the potential failure of banks. So that's the single resolution mechanism that has been established, the second pillar of the banking union. And we also need common deposit insurance. That's the third pillar that is still missing, of course. So where do we stand now? bank capital, that was one of the lessons of the crisis, of course. Bank capital needed to be strengthened, and it has been strengthened particularly in this region. So we started the beginning of the SSM with the capital ratios of the Baltic banks of around 28%, so that was more than twice the average in the SSM. Today we here have roughly, again, this is just aggregates across countries, we have roughly 20% CET1 capital ratios, 16% in the SSM, so still higher here than in the rest of the euro area, and also profitability is higher here. There has been strong micro and macroprudential policies. So the SSM, the single supervisory mechanism, has clearly contributed to higher microprudential standards, but also the macroprudential tools that are available, capital-based tools and also borrower-based instruments targeting the mortgage market are applied in these countries. And there's a lot of cooperation, of course, with other Nordic authorities because of the dominance of banks from this region. There are also differences between the Baltic markets and the rest of Europe. One is a relatively high degree of concentration. So if you look at the standard indicators, so the market shares of the 5 largest banks, for example, they're around 90% in the Baltic markets, which is higher than in the rest of Europe. The fact that the markets here are relatively small and, of course, have their peculiar national regulations might play a role. So there might be implicit entry barriers related to that. And also relative to GDP, the Baltic markets are relatively small and dominated by banks. This is actually why capital markets development, as has been mentioned before, is so important. But let me look a little bit more also into the future, and that the future clearly will be more digital. And I'm sure that there's many representatives here in this room of providers of digital financial services. So this region is really leading the way in terms of development of fintech solutions, very often payment solutions, for cross-border financial services, and very often also financial services provided for non-residents. And this already tells, I mean, I've been mentioning the regional proximity in terms of entry of foreign banks, but the cross-border of digital financial services already tells that regional proximity borders will become less important in the future, and maybe this can also further stimulate the integration of markets. So that would clearly be a good thing to happen. But we know, and this is also the supervisory perspective we have to take, that the rapid growth of digital financial services entails risks. So any financial institutions, including fintechs, of course, have to obey to consumer protection requirements, prevent fraud, deal with cyber risks, AML-related issues, financial sanctions. So there's a whole range of course, risks that need to be dealt with, and that can be, if they're not properly managed, that can lead to very severe reputational issues. So any bank, of course, any financial institution needs to invest in risk management, management of third-party risks and other risks related to digital strategies. And I think actually the currently good levels of profitability provide a good opportunity to make these investments. And we, of course, monitor very well what the banks under our supervision, what they do and how good their risk management systems are. Let me be very clear, supervisors are technology neutral. So figuring out which technology to use best for the provision of financial services, this is not our role. But of course, we clearly have expectations regarding digitalization strategies, and we are also gathering sound practices so that we can also help banks to benchmark against each other. Cyber risk, I think it goes without saying, is clearly a growing concern, not only for this region, but of course, particularly for the Baltic region, as geopolitical tensions and digitalization expose financial institutions to cyber threats. This is why we in the ECB and the SSM have conducted our first cyber resilience stress test this year. So this looks at the response of banks to a successful cyber attack. It's not about the prevention, it's about the response. And we found that the banks are prepared, but we also found areas for improvement, and now we're working with the banks to remediate the findings that we have, and clearly investment into cutting-edge cybersecurity technology is key. And this is a very positive development. There's close cooperation, of course, in this region, also cross-border, to address cyber risks. The same needs to be said about the violation of anti-money laundering, counter-terrorist financing rules. Also there, significant improvements have been made in this region, in particular because violations of these rules can seriously undermine the reputation and viability of financial institutions. And we work very closely with the national authorities to understand what happens in this area and what could be implications for the banks. And we will certainly also closely cooperate with the European Anti-Money Laundering Authority, AMLA, which will take its seat in Frankfurt. So looking further ahead, what are the most important areas to promote further integration? Again, the banking union started as a project to increase resilience, to promote integration. I think this is good for consumers and firms because they can access financial services across borders. It's also good for banks because in an integrated market, they can use economies of scale and scope, diversification, benefits that can sometimes, of course, be realized through mergers. But for these benefits to realize, sound risk management and governance are essential. This is why we have in 2021, so 3 years ago, we have clarified our approach to bank mergers, and in particular made clear that we treat domestic and cross-border mergers according to the same criteria. This holds generally for Europe, but I think the Baltic region is an interesting case study of the importance of integration, but also to some extent the limitations of cross-border integration, being very small open economies which had to go through a deep economic transformation and which followed a dedicated strategy of fully integrating into the European single market. And I think it's very well recognized and appreciated by supervisors that this integration also comes with a very high degree of resilience. And I think it's also good to see that foreign banks' cross-border integration in that sense played an important role in improving services and also in terms of strengthening the financial systems here. But I think we need to move ahead and also think about the issues related to digitalization, which does provide opportunities clearly, but it also requires good risk management and supervision. And I think it also requires, in the end, as I said, European deposit insurance. So depositors need to be assured that their deposits with domestic banks are covered by the same standards as deposits offered by non-resident banks. And last, but certainly not least, and it has been mentioned before, I think also the financial development that we've seen in this region really provides a compelling case for broader European integration and cooperation, in particular through the Capital Markets Union. So Capital Markets Union for me is really two things. One is greater harmonization of relevant rules so that implicit barriers of entry don't matter so much. That's in the space of insolvency legislation. Also, we have very specific rules affecting national mortgage markets. So these are two examples, but there are many others as well. And Capital Markets Union also helps European firms accessing equity finance, which is needed to finance also risky and more innovative projects. So access to equity finance, better risk sharing will benefit the euro area as a whole and will also benefit the Baltic states. Thank you very much for your attention. I look forward to the rest of the conference.
Thank you, Claudia. I think that you shouldn't be leaving the stage because we'll get you in the panel very, very soon. Okay, you have left anyway, but you'll be back. Okay, I hope. I will then invite, this will be a very high-level panel with a super high-level moderator, and I think we'll work like this. I will read out the names and titles, and as I do start coming up on stage, and then I'll invite the moderator, and then we kick off. So, on stage, could I please have the Minister of Finance of the Lithuania, Gintarė Skaistė, Chair of the Supervisory Board of the European Central Bank, Claudia Buch, Chairman of the Board of the Bank of Lithuania, Gediminas Šimkus, Governor for Eesti Bank, Madis Müller. Joining us online will be the Latvian representative, Governor of the Bank of Latvia, Mārtiņš Kazaks, and CEO of Nordic Investment Bank, Andre Kusvak. And I would also like to invite on stage the one and only Vice President of the European Markets at NASDAQ, Arminta Saladžienė. We now give them a very big round of applause, and then they kick off.
Ville, good morning, everyone. I think after a perfect mix of intellectual and sensual stimulation, we have all warmed up. And we are very fortunate to have an exceptional lineup of contributors today. We are less fortunate to be under very tight time constraints. So let us dive into discussion without further ado. And the Prime Minister, the Minister and Ms. Buch actually made a perfect introduction for our panel. I will just add that to accelerate EU's growth, Team Draghi have estimated that the EU needs to raise its investment ratio from 22% of GDP to 27%, a rate not seen for more than half a century. And that translates into roughly 800 million euros annually that need to be injected into green and digital transformations, into security and defense, competitiveness and strategic autonomy, practically everywhere. Obviously, public finance and banks cannot fulfill these funding needs alone. And here is where the capital markets come, and they need to contribute in mobilizing private savings, attracting international capital, and channeling this into productive growth. Are the EU and Baltic markets ready to deliver? What policies, industry actions, and reforms may be needed to actually make the change? The topic, of course, is very broad and complex, and we will look at it through two angles. How to boost capital supply and serve the capital demand, and then what needs to be done in terms of the design, regulation, and supervision of the capital markets to make them fit for the future. So let me start with a setting the scene question to all panelists, and I will very much appreciate really brief answers. On a scale of 10, how would you measure today the efficiency of European capital markets to drive competitiveness and growth? And if you had to name the number one gap or shortfall, what that would be. So let us start with Ms. Buch and just follow the line.
Thank you very much for the question. I'm an economist by training, and from economists you have difficulties getting a number on the rating reforms. But let me answer your question saying that in order to get growth, starting higher growth, I think we really need also a lot of political clarity for long-term investments and innovation. And I think then also the funding from capital markets will also come. It's good if we make progress on the capital markets union, but I think we really need the clear policy frameworks that also help investors to make their plans and invest into the long-term projects.
Thank you. Minister?
I would say that European capital markets, it's relatively well developed if you compare with the other continents, but not if you compare with the United States. So it depends always when you write a number, you should always keep in mind the other competitors that you have in the world. So I would say at the present moment, it's 7 out of 10. We can do more, definitely. And I hope that we will do that in the political cycle that is coming, because I feel the urgency, I feel the need, and I feel the understanding that we should do something because of the competitiveness of European continent. But for the small countries like Lithuania, for us, it's really accessibility to the capital for small and medium enterprises is the biggest issue. So I would say that we need to do more, and we're doing what we can at our level, but at the same time, European decisions should be present.
I also think that it's all relative. One thing is when you compare, and the thing is that the capital markets are quite fragmented in the EU. So one thing when you compare, let's say, capital markets here in Baltics to the ones in bigger economies. The other thing, when you compare European capital markets today with the ones we had 10 years ago with London or UK being part of EU and London as a financial sector. And the other thing is when you compare the capital markets in the EU with the US. But I very much agree that capital market union or the place or a better place where savings meet investments are crucial, and they explain much of the productivity difference between the US and the EU, but it's not the only thing, not the only explanation. We need also more single market in terms of the defense, in terms of the finance, banking finance, but yes, Europe is very much dependent on the banking finance. Therefore, capital market union development is one of the main goals. As for the grade, I have not answered your question. Here in Lithuania, we don't put grades for pupils in the primary schools. So I will abstain from giving a grade, but I think we're quite in early stages of development of this really strong capital market union.
Thank you. Mr. Müller?
Thank you, and thank you for the invitation. I'm not sure if we're in the primary school anymore, so let me still give a grade. So I would give it a 6, perhaps. So certainly there's a long way to go. I think we're overly reliant on banking. Still in Europe, also, of course, it applies to our countries. And the lack of well-functioning capital markets, of course, is a particularly big problem for smaller countries such as ours. And if you ask for the biggest gap, it of course has to do with not enough harmonization, too much fragmentation in the market. So that's what we should work on. I think the problem is also the lack of capital or institutional capital compared, for example, relatively speaking, to the US market. Mm-hmm. And this has to do with the supply side that you suggested we should also discuss.
Yes, thank you. Mr. Kusvak?
From my end, as I'm a banker, my job is to come up with specific numbers. So the answer is 6, okay. US being the benchmark. However, in brackets with an upward trend. And I would say the biggest problems are fragmentation, anything that particularly links to the post-trade plumbing. And then secondly, the risk culture, or rather the lack of it sometimes. You know, there is capital both on the investment side, but also on the issuer side, lacking on the riskier end of the scale.
Thank you. And Governor Kazaks, we can see you. We hope we can hear you. So what would be your take on this?
Yeah, thanks. As for euro area, we have one currency, but we have 20 separate financial markets. And that is by all means holding down growth. We nurture our national champions, but our national champions turn out to be international midgets. And, you know, competing then is extremely difficult. So anything that we can do to reduce this fragmentation, to bring down those fences and open up financial markets similar to the single market in goods, that would be by all means very beneficial. As for your grading exercise, I would very much agree. I'm going to be a bit more generous than my colleague governors, and I would give 7 out of 10 for Europe, similar to what Gintare gave. As for Latvia, unfortunately, I cannot give more than 3 out of 10, and that is only because the infrastructure is there, but there is no activity. So the 3 is for infrastructure, is, I don't know, very, very low number for activity. And let me just give you a couple of numbers. Equity market capitalization in Riga Stock Exchange at 0.5% of GDP, down 82% compared to 2008. Now, nearly 20 years ago, activity was much, much bigger than it is now. As for bonds, that activity has picked up, but still only 3.5% to 4% of GDP. So we have the infrastructure, but there is no business. Thank you.
Thank you very much. So political will and long-term focus on risk sharing and innovation, access to capital for SMEs, especially relevant for our region, and our bankers seem to be very, very aligned, actually, that fragmentation or overcoming fragmentation and moving towards more single market is really the way forward. And I think we have now averaged on 6 to 7, which is like high satisfactory, low good. Let's be positive, then it means potential is great. Let's focus on that potential and look at the capital supply side. So when we deconstruct that looming 800 million number of annual investments, additional ones needed, and look a bit historically, then around 80% of productive investments in Europe have been coming from the private sector. So the importance of private funding is huge. And Minister, let me ask you, how would you assess the current state of private investments, and then what measures and instruments you called us to be solution-oriented? So let me ask what you think measures could help mobilize and stimulate private investments, both on the European level and more specifically in Lithuania and the Baltic countries?
When I first read the article in media about Mr. Draghi's report with those numbers, the comments from public society was that how we will collect these funds to fund what is needed in Europe. And clearly, if you understand the numbers, you understand that 4–5% of GDP additionally annually from public investment side is just not achievable. It's not something that I can imagine in my dream, because we are discussing on 0.5% of GDP to defense from public funds, and these discussions were very tough. So 4–5% from public budget is not something that will be someday present. So anyway, we must understand that the biggest share of these funds should come from private investment, and then we must discuss what can we do more if we want to achieve those numbers. And if the only answer is fiscal stimulus from tax regime, so that's not the answer, because this will decrease the public funds at the same time. So the answer should be the mix of different measures. Maybe there should be some tax incentives, and we already have very generous tax incentives, at least in Lithuania, for productive investment, for research and development spending also. So what we can create more? So my answer would be simplification, lowering fragmentation between different member states, in trying to include more institutional investors, and giving them incentives to invest here and not taking out the funds and not leading the funds in funds without using that. So how to channel that to the investment, that's the main answer. And also how to take private savings and channel them to the productive investment. I would say that the answer is making process easier, faster, and more understandable for general society. So there is no silver bullet, but at least I feel the general understanding in public and private authorities that we need to find those answers. And if we do not, we will stay behind the US.
Thank you. And we often, often or seldom, but we sometimes hear the voices saying that maybe Europe, the EU, should reconsider its super ambitious decarbonization agenda. But we also, I think, read very clearly in Mario Draghi's report and heard from the president of the Commission that that should not be the price to pay, and because it is definitely part of the future. So if we look at sustainable finance, then I look at Mr. Kusvek and the Nordic Investment Bank leading in that area. How would you assess the state of play in this area, and what financial instruments or policies could help make this sustainable finance available not only for large corporates, but also for the medium companies to actually help them with the transition?
Thank you for the question. As I'm primarily responsible for the Nordic-Baltic area, then I would say that the sustainable finance in the Nordic-Baltic area is basically in a pretty good shape. Clearly the world leader, I would say. There seems to be a good level of consensus both among the investors that are willing to place their assets into sustainable and green assets, but also now increasingly more and more on the consumer side. So that is one thing. Secondly, I think Europe as a whole is also in a pretty good shape. The two things that have been missing and where there is still quite a lot of evolvement happening, of course, is measuring and reporting. And good strides have been made on that front too. The Corporate Sustainability Reporting Directive is a big step towards it. The EU taxonomy is gradually forming into something that people start to understand. And then finally also the international other reporting standards such as the ISSB or the International Sustainability Standard Board standards and the banks and other investors increasingly aligning to those is also, I think, moving us in the right direction. What I'm really happy about in Europe and the signals we are getting from Ursula von der Leyen, for instance, is that competitiveness and productivity has been now raised to the forefront of the focus. And I think that's really important because we can be the cleanest of the clean in this part of the world. We are not going to stop the climate change if it's not being helped by other parts of the world. But the truth is that on the productivity, our demographics is not helping us in Europe. We have to be clever and fast and smart, even if we are small or getting smaller in relative terms, in terms of the global population. So I would say that, you know, investments into R&D, technologies, digitalization, any innovation, it's really important, and the Nordics also are very much in the lead of it. So if you look at the R&D investment as a percentage of the company's turnover, you know, in the Baltics, for instance, nowadays the standard is being set to what is called 2% club. In Finland, it's 3%. In Denmark, it's over 4%. And there are several companies among the Nordic Investment Bank clientele that actually have over 6% R&D investment. And I think this really matters in the end.
Great to hear that this is one area where our region, broadly looking, the Nordic Baltic is leading. I think another area where we also see is the success of breeding startups. and really successful tech companies. In the recent feature, the Financial Times mentioned, I think, 5 large tech companies in Europe, the next and up and coming towards the public markets. Out of those 5, 4 were from the Nordics and the Baltics. But we are not so successful in actually helping them scale and stay in Europe. The same Draghi's report alluded to 30% of European companies which moved their headquarters outside the region, and mostly seeking financing, but also for the more flexible regulations and more agile and dynamic business environment. So we have on this panel really the 5 bankers and 4 central bankers. Mr. Šimkus, why is this a topic of relevance for central banks, that the companies get access to also market funding?
Well, it's definitely a very important topic, but let me start with mantra that no matter what's the progress on capital market union, monetary policy has very clear mandate and very clearly defined objective, 2% inflation in medium term. But getting back to the question, and if to open an umbrella, so euro, our monetary policy in the euro of ECB is this is a single currency for euro area, so capital markets, capital market union, effectiveness of the capital markets, they add the singleness to the area in which we function. And if to single out why capital market integration, consolidation, and effectiveness is important for monetary policy area, or for monetary policy, I would single out 3. Definitely, this is not the overall list, but why? 3 things why it's important. First, everybody now repeats the Mario Draghi and its report on productivity, but that's exactly the reason why this is important also for monetary policy, because, as I said already, capital market union is basically a place or improvement in how savings meet investments. And if you make the process more efficient, this implies that savings finds more productive, more innovative investment opportunities. And this leads in the overall opportunity growth. And as many studies shows, this leads into a higher potential output. And then consequently, higher natural interest rates, thus creating more monetary policy space for implementation. And that's why important. The second thing is, risk sharing. So, and here how we differ a lot from the US. So, for instance, 1% drop of growth in the EU implies 0.8 percentage point decline in consumption, and only 0.2 in the US. So, risk sharing is 5 times less in the US than in the EU. Why I'm talking about this? Because risk sharing, or in a way you can think about as a diversification across the economic jurisdiction, or better distribution of the investment opportunities and savings across the euro, leads to a less vulnerable countries to the local shocks. And if we are less vulnerable, less sensitive to the local shocks, which cannot be dealt in fact with a single policy with a single monetary policy. This means that we can help stabilize the economic growth. And the third, the big thing, I think the capital market union is one of the very important pillars of the open strategic European autonomy. And it's very important because it reduces our areas already sensitivity to the global headwinds, and makes us less sensitive to the global shocks.
Mm-hmm. Thank you, Governor. And when we talk about, of course, the capital markets, the capital supply side comes to the top of the agenda, and this was underscored also by the same Draghi's report that this is where EU is really lagging behind the US. And as one of the measures suggested by the thought leaders is expanding the second and third pillar pension systems to actually boost this capital supply. Now, if we look at the Baltic countries, it seems that we are moving or thinking of moving in a bit reverse direction. Unlocking or considering to unlock the system, reconsidering auto-enrollment, maybe even lowering contributions to the second pillar pension fund. So how do we reconcile the two? I'm looking at Governor Müller. Do you have some wisdom to share here?
I think we don't reconcile the two, and I think it's a good proposal of Draghi's report when it comes to having the pension systems that also support the capital markets are really in the benefit of the population, as we need to save for the future given the demographic outlook. But in Estonia, I think over the 30+ years we have been quite successful in taking wise sort of economic policy decisions. But now the experience shows we can also take some bad decisions, like, for example, when it comes to the mandatory pension savings. So what happened in our case is that from the end of 2021, the Estonians, who so far everyone who was at working age and working contributed to this savings scheme we call the second pillar. So in 21, you were able to take out all your pension savings and do whatever you want with them. So that's what about a quarter of the population also did. Now we have some lessons that we can learn from it. I guess if you're having a similar debate in Lithuania, maybe you can learn from it as well. So the outcome of it was that about 150,000 people took their savings out. In about 1 year's time. The data showed that about half of that money was just spent on consumption, which means this is something that those people will not have in the form of savings in the retirement. The rest of it was partly used to repay some existing loans that in some cases even might be reasonable if you really had very high interest rate loans. And a small share of it was perhaps also invested, and it's not obvious if it was really invested in a better way than it was done before. So the result of it is that on average the Estonian population is now more dependent on state pensions going forward. They have less savings, which I think is a problem really in light of the demographic outlook. And it seems to me that the government has also realized that it's a problem. So now we're moving a little bit in a different direction again. For example, starting from next year, there's a possibility for those who want so to contribute on a voluntary basis more to the same second pension pillar and get some tax benefits out of it. But I would say that the damage in a way already has been done. And in a way, the society now is split into two. So there is one part that is more reliant on government support going forward, and then there's another part of the population that is very keen in investing in the future, probably will contribute more to their pension accounts. And also when we look at the retail investors in Estonia, over the last several years, there has been a pickup in activity. We have had some IPOs of a couple of prominent companies that has helped. So if about 5 years ago we had just over 30,000 securities accounts for individuals in Estonia, so now it's about 110,000. So the activity has picked up. And one of the lessons for me is that the regulation of pension funds, of course, is critically important. You need to make sure that that you're not tying the hands too much of the fund managers, which would lead to lower returns. And that was something that was criticized in Estonia, that the pension funds are not doing a good enough job, but we also had tied their hands too much. And the fees were too high. So you need to make sure that the fees are low enough and the returns to savers accordingly big enough. Thank you.
Thank you very much for sharing these lessons. I think in the across the Baltics and Nordic Baltics, we're actually very good at sharing things. So hopefully these lessons will be also heard and taken into account, because some ideas are contagious for good or for bad. And I think that showing this linkage between the capital supply and the pension system, the second and third pillar, and the capital markets is critically important, that we cannot look into these topics in isolation. And next to the institutional capital, there is the retail part, the retail savings with billions of euros right now sitting in the current accounts or deposits. And of course, especially the Nordic countries show a very clear correlation between retail investments and the depth of the capital markets. Sweden, which boasts one of the highest retail engagement rates in the world, still, the current government actually has put forward very recently, they have not been adopted yet, but some tax incentives to free up capital for individuals and incentivize long-term investments even more. So the Minister Skiste has put forward the proposal of the investment account, which we finally will have in effect in Lithuania. How do we think we can channel those billions of savings, of retail savings, into capital market funding in the Baltics? And can we expect a significant uptake in these investments without the tax incentives? And we heard you that there is a correlation, public finance, private finance, but still, what can be done here?
I think that tax incentives help, but it is not the only answer. And it's a pity sometimes when the discussions focus only on tax incentives, because I think that without infrastructure, without easy and simple procedures, tax incentives are not working. So I think that our decision to have the investment account in Lithuania will help if we have additional measures, and I hope that technological solutions will come together, because we made the process simple. So you do not have to declare every year your earnings. You just declare when you take the money out of the account. That's easy. But at the same time, if you want to include the people who are having money in the bank's account, and 2/3 of that is not even with a interest earning. So the people just have the money in their accounts without earning 1 or 2 or 3%, which can be easily done. So you have to make the process so simple that the person who is just sitting at home and having his money coming in his bank account with a salary, to make the one button move, and he will invest in that simple and very understandable way. So my view would be that financial literacy is the something that we should do more. So we prepared the financial literacy plan for the society, for the focal groups, which I think is really important, together with the SMEs. The second thing is make the process simple, easy, and that's the thing that financial institutions, those institutions who provide solutions for people can do. And I hope that together with the investment account tax regime, it will be simpler and easier to do. And also the third answer would be the very simple, transparent, and easy, understandable, and trustable modes to invest. For example, like government saving notes, or the government decision to have the defense bonds that will be in the market in the next week already in Lithuania. So I just hope that these easy ways to invest will help the people to understand that they have to participate more and to invest more. Because I have read recently a survey about who people think that is a best advisor in the financial issues for themselves. So the best financial advisor, the society, general society thinks, are themselves. So people think that they know where to invest. So if we will not increase the understanding of people, traditionally they do invest in real estate, in something that they understand that they can touch. So if we want to increase the participation in capital marketing, to increase participation and investing in some financial products, the financial literacy is the only way.
Thank you. And building on that point of simplicity, let me ask Governor Kazaks one question. We hear from the market intermediaries and also some investors that regulations, like, for example, MiFID, MiFIR, may limit direct retail investments in public market instruments, and not to the same extent as into riskier assets like crypto or crowdfunding. Where do you think is the right balance between ensuring investor protection on the one hand and fostering retail engagement and market innovation on the other?
Thank you. I think that is certainly an issue to consider. MiFID is about 20 years old, in its thinking in certain areas. So some kind of revision or update perhaps is due to look at these things. But as to your question with respect to the crypto, and this, in my view, very much links together with the discussion on the second and third level pension. Namely, people do have the money, okay? But the question is, where do they invest, and what is the complexity of the move to invest? And in terms of crypto, that market is not fragmented, and it is not fragmented along national borders. So in a way, it is much more fluent, it's much more seamless, and people can do the decisions in a much easier way. So this is again the issue of fragmentation or no fragmentation. It does not mean that necessarily we need to build again those new fences so that also the crypto market becomes very fragmented. But I think we need to do the opposite thing, to remove the fences and reduce fragmentation in our standard financial markets. But coming back to the second and third pillar, I fully agree with what the key points of Madis were. And I would just stress that it is, in terms of the volume in that, it's about 8 billion or 20% of GDP that is saved up in the second pillar pension system. But there is an important issue which again gets in public very much discussed, and this is the return from those savings. We've seen that the return from the second pillar has been much lower than from the first pillar. Of course, to some extent, pay-as-you-go at the very beginning is designed in the way to be much more productive in producing the return and growth of the capital. But this is not going to happen going forward when the societies are shrinking and they are aging. So I think it is extremely important to boost the return from the investments in the second pillar pension. And there are at least three arguments that we should be very, very cautious about and make the right decisions. One is fees, already mentioned by Madis. Some of the fees, given that the volumes are growing, in my view, are in need of being reduced because the fixed costs for management are coming down. As for the benchmarks, at least in the Latvian case, we've seen that in the past, the benchmarks have not been very ambitious. So for the variable fees, I think the benchmark should be increased so that the fund managers do work more to get the return and also to get the fees. And the last one, I think, is of critical importance, is that people are part of the appropriate pension plans. Young people should invest more in equities and less in bond markets or other fixed incomes. So this mismatch has also been weighing on the return from the second pillar pension system, which politically, of course, puts the system itself under pressure and may lead to the outcomes similar to what we saw in Estonia when this is depleted very sharply just for current consumption. And this is by no means sustainable. As for risk diversification, and coming back again to this, to some extent linked to the crypto issue, is even if you would be willing to invest, for instance, in the Latvian economy, there are no sufficient financial vehicles, no instruments. You cannot invest in the Baltic economy, so you are forced to invest elsewhere. Kind of AIFs are still relatively small, so we need to create the infrastructure that these savings can flow into our assets. Thank you.
Thank you very much. And we hear a recurring theme of fragmentation, and let's look at how we can build a stronger union and what needs to happen on the regulatory and supervisory side. Ms. Buch, you shared during your keynote that the EU Banking Union turned 10 years old. Could you bring up some lessons, a few lessons that you think are relevant when we think about strengthening the capital markets union, or as it's being suggested, even like transitioning into EU savings and investments union? And do you see a role for the ECB in deepening this integration of the European capital markets?
Well, I mean, one clear lesson from the banking side is that it is actually very beneficial to have a single rule book, to apply the same rules across all the banks, and then to have a very harmonized supervisory standard across, in this case, across the euro area, how we apply these rules. So we do this, of course, the ECB is in charge of supervising the largest banks, the systemically important banks, the national competent authorities like here, Lithuania, Latvia, Estonia. They supervise the less significant institutions, as they're called, but it's all according to the same rule book. We have the same banking regulation, and we also apply, of course, not exactly the same tools then to the smaller banks. So this is also a bit in this discussion of the national authorities, but we have an oversight function so that this is all very harmonized. And I think this is beneficial. So this is certainly, when you ask what is the ECB doing to promote further integration, our task as supervisors is to make sure that the banks are sound and safe, so we don't have this, this first-hand integration objective. But of course, I mean, the safety and soundness of banks also means that they can operate across borders, they operate in the same environment, and this is clearly a big advantage. So there's certainly nothing that we would do that would stand in the way of integration. Quite to the contrary, when we speak to supervisors here across Europe, across the SSM, we speak the same language, and this is also something that the banks would recognize. So if any of this was a lesson for capital markets union, where it has been mentioned before, we have different supervisors at the national level. We don't have centralized supervision at the European level, and maybe we don't need it for all these areas, but we clearly need it for areas where there is cross-border activity, where there's also the risk of systemic risk that can spill across borders. So we know that also, of course, non-bank financial institutions, which are relevant for the capital markets union, they're exposed to risks, and this can have spillback effects for the banks. So we need to make sure that this is also regulated well. So I think this could be a lesson learned, that if we integrate supervision, if we coordinate within the system, if we work together, this has beneficial effects for the integration. It can also better help us deal with systemic risks that come up in the system.
Mm-hmm. Thank you. The high number of market infrastructures, be it trading, clearing, central securities depositories, is also being cited as one of the reasons of fragmentation, especially if we compare to the US. Mr. Kusvek, you deal with multiple of those market infrastructures. What do you think is the right North Star for Europe? Like, can we really benchmark, 27 versus 1, the US? And what do you think, based on your experience, could be ways to reduce this fragmentation in Europe?
Yes, I mean, Sweden was already mentioned, for instance, right? Which is that you have the highest engagement of private savings into capital market instruments. I think we all understand that building capital market union is way more complicated than building a banking union, because it all starts from grassroots steps, and you need to have that across issuers, investors, capital market infrastructure, legal and regulatory. Towards the end of the last decade, I was myself member of the high-level forum for capital market union development initiated by the European Commission. And of course, now 6-7 years later, I see that many of these things have moved very little from where the standard was set. But I would come back to what the minister said. The minister mentioned financial literacy. It links really what I started with, this kind of risk-taking culture. And let me just bring one quick case study. Like with any learning, it's easier to learn when you're younger. So let me ask the audience, how many of you have made an investment on behalf or on the name of your children for their future? That's pretty good, actually. But let me give you my own case study, which is that I have 3 children. For each of them, on their 13th birthday, I made an investment. We lived in the UK at the time, £5,000 each when they reached their 13th birthday. Comes with a certificate, there is £5,000 on your name. And I invested it in the equity index-linked instruments with principal guaranteed. And then they get a certain percentage over 5 years, so when they get 18, they know how much money they have made. It has an amazing effect. My 13-year-old son, a week later, comes back to me and says, I made £80 today. And I'm saying, like, what do you mean? He says, look, you gave me this investment. Now I developed an Excel spreadsheet. I put the index value in it, and I know that today it was plus 80. And then the next day it could be minus 30. And he gets to understand that you can't always win. And I think this risk culture and also accepting that sometimes you lose is crucially important. And now, several years later, sometimes I get a message from my youngest, who is a daughter, 22 years old, studying at the university, saying, look, there is an IPO of NFI Green. I invested 500 euros. Did I do good? These type of things which actually make them to think and participate, and they get to understand these structures. I think that's what we need to do. Also, finally, from where we are in Europe and where the US is, that maybe the benchmark, it's really difficult to jump that gap. I think we need to look at something that is somewhere in between and perhaps has developed its capital market in more recent times. In Europe, certainly UK is a good example. And in Asia, I would say South Korea, which has really developed different segments of the market and made it available, injecting a little bit of either tax incentives or state capital in it, but then largely letting people to take their own risks.
Thank you. That's really inspiring. And when we talk about the single market, the single rule book and single supervisor are being quoted also on top of the list. Ms. Buch, let me challenge you with one question. If you look at the EU, is it the fragmentation and divergence of the rules, or actually it's more the excess of them, the excess of regulatory burden that is at the heart of the problem?
No, I don't think we have excessive regulation. I mean, just talking for the banking part, for banking supervision. I mean, you hear there's a lot. You hear that regulation is complex, no? And then I always ask, well, why is regulation complex? I mean, first of all, modern banking is complex, and we need to take different business models and different types of risks into account, and this is all reflected in the regulation. So you wouldn't expect a very complex sector to be regulated in a very simplistic way, because then we would just be missing relevant risks. Then another reason is, and I think this is really important, I think this is also a reason why a lot of European projects don't really make that much progress. And again, there's good reasons for doing it, but the outcome is that as we negotiate new rules in Brussels, there's also a lot of national specificities and national rules and legislation that needs to be taken into consideration. And then very often the outcome of these negotiations, and there's consultations, the outcome is not necessarily something simpler, but something more complex. You can actually see it when you see how Europe has negotiated the Basel III package, the banking package, which, by the way, should be implemented. So because this would be good for resilience and also for trust in the European banking sector. But clearly the outcome of what has been negotiated is more complex than what was originally intended. So the question is, how do we get out of this? Of course, I mean, there's always ways to reduce complexity, but clearly it can't come at the expense of resilience. And we should also, you know, always remind ourselves why we have certain differences and complexities, and not just move to something simpler, which then makes us overlook relevant risks.
We now have the commissioner with the portfolio for simplicity, and it's actually Valdis Dombrovskis, a really great, experienced commissioner. So I think hopes are high that he and the team will find some cues there. Now, if we then take this single rule book, let me ask Governor Müller, do you think it really works for all markets, all players, or should we be calibrating it to, you know, relative to the size, the state of development? What would your take be?
I think we really need a single rule book for the Capital Markets Union to work. Of course, it has to be differentiated for smaller firms, bigger firms. Perhaps some differentiation also for smaller markets, as there might be some specificities, but I think it's more important to make sure that we're not burdening smaller and medium-sized firms too much if they want to access capital markets. So from my perspective, it's really about access to finance to firms in particular. Of course, we also want retail investors active to provide the capital, but I think it's already relatively easy for me. For example, if I want to invest in, I don't know, German equities, I can do that. But it's difficult for an Estonian firm to go and raise capital from, say, German investors. So that's where we need improvement. We need rules to be harmonized more. And it's not only in the hands of ministers of finance, but there's a lot about you know, the legal framework and the business law and bankruptcy law. And this is something that is so different in different parts of Europe. So I'm just very glad to hear from the minister if she says that there's a sense of new urgency and an understanding that we really need to work on this.
Thank you. So single rule book goes hand in hand with the supervisory framework. So let me ask Governor Kazaks, what do you think of the new design of the supervisory framework in Europe? Should it be centralized all under then the single regulator, the supervisor, like ESMA, or then we need to maintain or maybe adapt the hybrid model?
I would think that, the mindset that I think we should take is if we stay fragmented, we have a lot of nothing. If we reduce fragmentation, we have a chance of having a bit of something. So a lot of nothing or a bit of something, I think from an economist's point of view, it's a no-brainer. A bit of something is always better. And I think also the same thing in terms of the supervision. You know, if it makes the things happen, then of course we need to do it.
Thank you. That was very clear. And then let me ask Governor Šimkus and bring maybe some controversy to this. We know that the capital markets work like as, you know, ecosystems. And I think the achievements we have made in this region were thanks to this very close interaction and collaboration between the government, the supervision, the market participants, market infrastructures, and everyone really acting not only in concert, but with the highest sense of urgency. So Do you see any risks and challenges with the centralized supervision? Let me throw this, like, where would we be in the priority line, or how long would it take to introduce some innovation, for example, and other things? Or you think that the benefits would outweigh any of these risks?
So the way we discuss it now, I think already a little bit of a risky thing, because I think when talking and actually dealing with the CMU, the major risk that we may end up treating symptoms and not the causes. And I think this single supervisor or various infrastructure things are rather symptoms, or problems in infrastructure are symptoms and not the causes. I think causes lies in differences of legislative, legal, and regulatory practices across the countries in the EU. And as I say, so infrastructure is just a symptom, just an example. I saw here many professionals, and they are definitely familiar with the abbreviation of T2S. But for those who don't know, this is the common infrastructure laying the single markets for security settlement. Sounds great, right? But alongside this platform, there are multiple central security depositories that run their business or settlements on their own for securities and accommodate the national features and national regulatory requirements. So here, again, I will reiterate, I think the risk is that dealing with CMU, we should not kind of be dealing with symptoms. We should go into the causes. We do have single banking supervisor. I dare to say we don't have that much of a single banking services market. So yeah, thank you.
Yes, please, Mr. Kusek.
Very quick remark on what the governors, each of the three of them said. Governor Müller said that it's more difficult for a smaller Baltic company to go to Germany. I think it would be even nicer if the company doesn't need to go to Germany, that it is indeed one market. That company can list here and the German money flows over. Nowadays we can transfer money within seconds within the SEPA, the Single European Payment Area, not only because the banks are doing better, but there are also fintech solutions for this type of thing. So I think the trend is always that investors in the smaller markets always also invest in the bigger markets. Very rarely bigger market investors invest in the smaller markets. I think we need to look at it as one market so that a little bit of something from Germany comes and creates something that is quite a lot in our smaller markets.
Thank you. Our time is up. Let's use 1 minute to do really a flash summary. And we've heard there is no one silver bullet. I think we now just touched a little bit, scratched the surface with possible solutions. If you were in lead to set the agenda, what is the #1 action you would undertake? Please.
Well, implement the policies that are needed to close the banking union, EDIS, crisis management, and not wait for the next crisis.
If there is the only thing I can do, that would be capital markets union. So,
okay, not a small one, I guess. Governor Šimkus?
Yes, set up a team who runs over the regulation of capital markets across the euro, at least euro area countries, and try to dig or to kill the differences.
Kill the differences, yes.
Yes, I think what Gedimina said is sort of an overall theme, and it's hard to pinpoint one specific rule that is a problem or a piece of legislation. But in fact, the European Commission has a very clear action plan that is just sort of stuck somewhere. So I think we know what we need to do, and it has to be implemented.
Just do it. Thank you.
If there is only one thing to do, then start investing, not next week, today.
Good. Great. Thank you. And Governor Kazaks?
Just do it.
Just do it.
That's for capital markets union. For capital markets union, if we cannot do it on kind of this project was stuck somewhere, let's create regulation number 28, which is the same for everybody, and that's it. Thank you.
Great. I think, I hope the audience also felt the sense not only of urgency but determination here on the stage. So let us all thank our wonderful contributors and let's just do it.
Thank you so much. I think to the flash summary, I would just add the phrase that we've heard from our online guests. If we stay fragmented, we have a lot of nothing. If we reduce fragmentation, we will have a bit of something. So that's, for me, the key phrase, the key takeaway of this discussion. Thank you so very much. We will now have a coffee break, and I would really ask everybody to come back here at 11, so we can continue high-level fireside chats, debates, and conversations. So enjoy your coffee, and do come back here at 11. Thank you. Welcome back, everybody. If you have ever been to a conference that ends on time, that must have also been a conference that started on time and all of the breaks were on time and everything was fine. So we will begin and we will kick off. We will move on despite some other people doing some networking. There will be chances for networking over other breaks. There will be a lunch break after this session now, which is roughly in a good hour. We will have a panel debate on IPO landscape. Scarcity of investors or suitable candidates is the question to be raised. But before that happens, we will get to listen to a super interesting fireside chat that will be with Chief Financial Officer at Vinted, Lithuanian unicorn, Maurizio Darigo, and he will be interviewed. He will be talking to co-founder and managing partner of Wallace, another super impressive one and only woman, Miss Dovila Burgena. They're both nearly on stage. Let's welcome them closer and then listen to what they have to say.
To be here, and I'm one of these 5 people that actually attended all the 10 conferences. So I don't mean that I'm old, but I'm persistent. I really believe the market will develop at some point. So let's find out. So today we have on stage a rare opportunity to talk to a company that may do an IPO at some point, and it's a company that we're all very proud of, and it's one of these companies that would be an ideal candidate to boost our capital market, but we have to make it attractive to them because they're doing so good. So Maurizio, you were introduced, so I'll start with the first question, and that relates to your past experience. You spent a lot of years at eBay, and you were listed all those years as a company. So what is your experience working for a listed tech company, and what did you do, and what do you think